thought that timing the market doesn't work. I mean, if it worked, we wouldn't have needs for networks like this if there was a way of really going about it.
Bite your tongue.
Yeah, and faithfully doing that. And what people need to realize is that, as you said, if you just miss the top 30 trading days over the last 15 years, instead of having the positive rate of return that we've had since the market rebounded in 2009, you would have actually had negative return. But what's even more interesting about that is that some 75% of the best days in the market came within 2 weeks of the worst days in the market. Now, we've seen that play out just
Huge
recently.
rebounds, in other words.
That's exactly right. So when you get scared out because you get all panicky, you're almost a lock to miss that rebound.
This is incredibly important because, I mean, you get these huge down days. We had December, a month to forget, very volatile. People get spooked. When they get spooked, often they sell. Yeah. Don't do that. But often they do that. And your point is that, A, you're probably going to miss one of the best days. And B, especially if you sell close to one of those big down days. Again, don't do that.
Well, if you try to time the market, think about what you have to do. You have to make 3 decisions correctly. One, you have to make the decision that we're about to go down and I have to get out. Then you got to get out. Then you have to look at, okay, I'm going to get in, but you're going to get in when everything seems down and we're talking about negative markets on programs like this. And you have to have the fortitude to say, no, I'm going to get back in. And then you have to have the smarts to do it again. Well, and rinse and repeat. So that's why it's kind of a fool's
And nobody,
errand.
I mean, no disrespect to anybody who appears on this fine network, but very few people, nobody has the smarts to predict when one of these amazing up days is going to happen.
No, and I will give credit to someone I think is very smart, Dr. David Kelly from J.P. Morgan. He recently said on a call...
Very frequent guest on this network, good Irishman,
Yeah, he said on a call something that stuck in my mind. People that wait for the market to settle down are missing to the point that markets don't settle down, they settle up. And what he meant by that, I believe, was that when things calm down, they're only getting calm in your mind because the market's moving up. And if it's moving up, in many cases, you might have missed the first 1, 2, 3, or even 10% of that upward move. So you can't wait for that calm to come. Risk-taking is about managing your portfolio and how much risk you could sleep at night. If you're not sleeping at night, it means your portfolio isn't balanced correctly for your risk tolerance. It doesn't mean that you shouldn't be in the market.
Well, you may not be sleeping because your friends and clients probably have been calling and saying, what the heck should I do? The market volatility scares me. Should I sell everything and run off? So leave us with some actionable advice. What have you been advising people to do right now in this environment?
Well, one, I've been saying that we're in an environment where things are rolling over. Even though the 2 wealthiest men live in the same neighborhood, the entire stock...
You're not one of them. No
Well,
offense.
that's fair enough.
Not you, but people you talk to.
But your portfolio doesn't have to live in that neighborhood with them. We're starting to see the market roll over from these big names that, people are realizing that Amazon is not going to put every retail store out of business. Not everyone's going to want to give up their privacy to Facebook, and not everyone needs to update their iPhone to the next model. So we're going to start seeing the market broaden out to much more value names, the kind of names that you should have in your personal account, your retirement account. I mean, it's okay to have a small amount of money trying to get that go-go octane out of an account, but what I'm recommending to people is keep a diversified portfolio, recognize that cash, bonds, fixed income represent a role.
Mix it up.
Even though it might not be giving you a great return, but stop chasing returns. Slow and steady will win the race.
Yeah.